Welcome back to the Smart Investing Show, and it's time we talk to our financial planner, our Harrison Johnson, our CFP here at Wilsey Asset Management. Harrison, thanks for being here today.
Always.
I saw your topic. How would an S&P 500 portfolio work in retirement? I have my feelings, but I want to see what you say because I know you do the retirement planning for people and so forth. So is this a good thing or a bad thing?
Well, I guess it depends when you retire and what the S&P does, like with any investment. But the reason why I bring it up is because, there's people out there that they had their 401k invested in the S&P, and now they're going into retirement, and they look at the last couple years and, oh, my 401k has done pretty well. I think I'll just I'll stay with that. So I have a parallel to look at the 90s because a lot of people did the same thing in the 90s. If you look at the return of the S&P, from 91 to the start of 2000, it was positive every single year.
Oh, wow.
And from 95 through 2000, so that last 5 years of the 90s, the average return of the S&P was about 30% a year annualized.
The last 5 years. That's a tech boom.
So I mean, if you're retiring, if you were somebody who retired, right around 2000, look at the S&P. Wow, investing's really easy. You just the money just goes up every single year. So it's as easy as that. So if, for example, and I thought about this, my dog woke me up the other night, and so I couldn't get back to sleep. So
and you got a big dog, don't you?
Well, that's why. Yeah,
Two big dogs. Two big dogs.
It's like 2 o'clock in the morning. I'm just thinking about this because I can't go back to sleep. So if you're somebody who retired in 2000, and you looked at the 90s and, wow, everything's so great, so easy. I'll just keep invested, and I should be able to withdraw money and, continue to make a lot of money in retirement. If you started with a very conservative withdrawal rate of 4% of a portfolio that's in the S&P, if you retired in 2000, within 3 years, half your money was gone.
So you lost 50%.
You lost 50%. Wow. So that's like if you retired at 62, by 65, half your money's gone. If you maintained that plan, so you kept your discipline and you stuck through it and you continued to withdraw money, and again, this was starting with a 4%, conservative withdrawal rate. 9 years into retirement, so by the time you're 71, now this is 2009, 2/3 of your money is gone.
Holy crap. I was going to say something else, but I don't cuss on it.
And at that point, if you wanted to maintain the same dollar amount that your withdrawal is, you're now not at 4%, you're at a 14% withdrawal rate from that portfolio to maintain that level. So you retire at 62, by 71, 2/3 your money is withdrawn, and you're withdrawing now 14% to keep up. It's not sustainable. So, we're seeing something similar right now where the S&P has done well, but really a lot of things have done well. So, I mean, when everything is going up, a lot of things just go up. But retirement lasts, 20 to 30 years. And if you look back, from where we are now, in the last 30 years, we've had 4 bear markets. So that's a correction of over 20%. And that's a pullback of over 20%. And we've had 20 corrections. So that's a pullback of at least 10% in the last 30-year span. So people are retiring now. You're going to go through hard things. And so you need to be aware of that. And just because, a certain investment strategy has done well, maybe that's not because of that investment strategy necessarily. That's because everything did well. And, you look at the S&P, the average return of the S&P over history is about 10% a year. But that kind of can be misleading because if that average is 10%, but if you start withdrawing going into a down market, or you're withdrawing as you go through that, in many cases you deplete that portfolio more than it can realistically recover. So when you're looking at retiring, you really need to be careful of, yes, you want to make money. We're not talking about selling annuities or being so conservative that you don't make money anymore, but you need to be realistic on what really can happen with a portfolio like that.
And I think people don't realize when you go down 50% or 66%, I think you said, you cannot recover because you're taking on the same distribution, you're taking more of the portfolio. This is why in our income program, we look at it very closely. I tell people, be careful about taking out too much. We watch it very closely. And we've done ours for now 26 years. Our distribution rate is 6% because of the way we manage it.
Yeah, and that can be done, but it's definitely not easy. And so when the market is going up, it feels very easy. But to maintain a withdrawal rate of 6% through, a 30-year span, that's hard.
Right.
It's great when, the market goes up 20%. Oh, we only withdrew 6, so the portfolio grew. Well, what happens when you go through a period where it's down and you are also withdrawing? To your point, Brent, if you lose 50%, what do you need to get back to even? It's not 50. Now you need 100% to get back to even. So the more you lose, and if you're withdrawing during that period, it makes it harder and harder to come back. So even though that, the S&P might eventually come back, your portfolio might not, because you were also withdrawing during that down period.
A couple of thoughts that I have for people. Number one, you did mention over the last 100 years, the S&P 500, the average annual return is about 10%. But the thing I look at is over the last 15 years, it's averaged 14% per year. So, I mean, just kind of mathematically speaking, if we have a reversion to the mean of 10%, I mean, we're talking about maybe a 6% gain per year. I don't know how the compounding works out, but just simple numbers. The other thing that I look at, just kind of looked at what happens with the average annualized 10-year return when the CAPE ratio, which is something that we look at, the cyclically adjusted PE ratio, is over 20, which we are there now. Historically, it's a 6% annualized return when the CAPE is 20 to 25. We are also above the CAPE of being 25. Historically, when we've hit this, the average annualized return over the next 10-year period is about 3 to 4% per year.
So that's where you get to a point where if you don't have the growth, because I mean the dividend yield of the S&P 500 is like 1.2% right now, maybe, depending on which fund you're in. So that means you need to be selling. And if you're selling at the wrong time to keep up with the withdrawals that you need for income, you're potentially not coming back from that.
Yeah, it's such a mistake that people make. They just look at the history. Oh, well, I can retire on this. They don't understand cash flow. They don't understand volatility. They don't understand overpaying for things. And that's why our income program works very well. But you're right. There's probably people like, oh, I've done so well in my IRA, my S&P 500. I think I'll retire and just take income from it. They don't get there's not the big cash flow.
And again, we've talked about this before, but it just blows my mind. The CAPE ratio right now is around 40. The historical average is around 16 to 17. So that's why, again, your future potential is not
People don't know
nearly
what
as good.
CAPE is. What does CAPE stand for?
Cyclically adjusted PE ratio. So again, it looks at the last 10 years of earnings on an inflation-adjusted basis. And, it's historically been a pretty good indicator of forward returns, and doesn't mean it's right every single year over like a 1-year time period, but generally over decades, it can kind of help with where we're at valuation-wise. And again, people just miss the fact, again, we've made about 14% per year. You're not going to have the same type of multiple expansion that we had over the last 15 years. So now is all relying on earnings growth, which I don't think we're going to have the same type of earnings growth. Plus, then you don't have the multiple expansion, maybe multiple contraction. That's where you lead to a S&P return over the next decade of maybe 3 to 5%.
So Harrison, somebody comes in, they've got 90% of their assets in the S&P 500 fund. Have you had that happen before? Do you?
I have. And so that's why, I brought it up because, whether it's somebody who retired and they were a government employee and they were in the TSP and they just had everything in the C fund. I don't think people are really aware of the risk that they're taking with that type of investment while they're also withdrawing from it. Now, there's some people out there that their income is fully covered by Social Security and pensions, and so their investable assets are, in whatever they are, but they're not really withdrawing from it. They don't have the same type of risk. You still want to make money, I would say. Oh, well, I don't care if I lose it. Okay, well.
Said no one ever until you actually
say that
do.
now when it's, at a high point. When you lose half of it, you're not happy. So, I mean, it's something that you can tell somebody, but a lot of times, we can talk about the math and the valuations and the numbers and history and everything, but until someone goes through it, a lot of times they don't want to listen. Yeah, I hear you, but I'm just going to continue to do it. Okay.
Yesterday we met with a client and we asked certain questions on a questionnaire before they come in. And one of those we ask is, what is your worst investment? And we never got this before. I've been doing this for 40 years. He goes, my worst investment was not hiring a financial advisor.
Not seeking advice sooner is exactly what he said.
Right, exact words. So your memory's better than mine, but I got the concept.
Yeah.
Yeah. People tell me all the time that they wish they had met me sooner. I mean, I get that a lot.
Well, that's why they need to call you now.
Yeah.
Well, Harrison, thank you very much. We appreciate it, and we'll talk to you more on Monday.
Thanks, guys.
All right, again, that's Harrison Johnson. He is our CFP, our financial planner at Wilsey Asset Management. As he said, people always say, I wish I had met you sooner. Don't be the one that delays and wait. Give him a call at the office, 858 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. He is a fee-based planner. He's not going to try to sell you annuities, and that's why people say, gosh, wish I had met you before.
Yeah, and I did want to have one more comment about his topic today was, past performance is no guarantee of future results, but past performance is generally how people make their investment decisions. And that is why I think people are potentially setting themselves up for failure here. Because, again, the S&P has done great. And we've been saying now for years it's expensive. But the problem is it keeps getting more expensive rather than actually coming back more into historical standards. So, I don't know, 5-10 years from now, it could still be wrong, but you have to make the best estimate you can with the facts that you're given. And right now, the S&P, it's expensive.
Yeah, and I try to tell people, don't look at the past performance, as you said. Look at the concept of investing. That's the important part, how you invest during good times and bad times, how you're going to handle that. Not just, the return was, 14% the last 10 years, so that must be good. No, that could be terrible because everything could be very high, and now next 10 years. And I think that 10-year return on the S&P 500, I think you said, I agree, around 6%.
3 to 5, yeah. That could be a very realistic possibility there. And, we'll see what happens. But, the thing we kind of looked at last week, we did the software stocks, and, you had a great 5-year return, but then your next 5 years were terrible. I mean, it could be something similar with the S&P here when we're talking in maybe 2031.
Yeah, well, we'll see.